All right, ladies and gentlemen, welcome to our special edition webcast on the Australian federal budget. I'm pleased to be joined by Michael Cornips tonight, and this session is presented by both Traders Circle and Emerald Financial. Before we start, a little bit of housekeeping. So any advice in this presentation is general advice only. It does not consider your personal financial circumstances, and you have to decide whether it's appropriate for you. All right, so tonight's session is presented by myself, Sam Green. I'm an equities analyst here at Emerald Financial, and I also sit on the trading desk of Traders Circle. I'm joined by our managing director, Michael Cornips. And Mike, would you like to say hi to everyone?
Good evening, everybody. Hope you enjoy tonight's talk. We've been running the business now for 16 years in running a stockbroking desk, education desk, equity desk, and after 16 years, it's still presenting a lot of opportunities to talk about. Thanks, Sam.
Yep, thank you very much. And, absolutely. So Mike sort of touched on it a little bit, but there's actually two separate businesses that we run. One is Traders Circle and the other Emerald Financial. Traders Circle is, I guess, what a lot of you guys out there might know us for, which is full service and support for predominantly short-term trading advice. So it's focused on derivatives such as options and warrants, and they also provide a lot of education and training. We do also have Emerald Financial, which is more of a research and investment advice group. We provide stock screening, stock reports, investment analysis, as well as portfolio management and execution services. So both of these brands are presenting tonight's event. All right, so we're here for the federal budget, and to be honest, it's one of the I guess most important budgets we've seen in the past decade or so. We've seen total government receipts drop by about 1.2% on FY 19-20 to 469 billion. To 463 billion, while payments are actually going up. So the amount the government is spending is going up to 677 billion, which is a 23% increase on what the government spent last year. So it's actually a big increase in spending.
Yes, it was interesting. The Liberal government started off with receipts equaling payments back in 2006-07. Labor took over, and coming into the GFC, they took that from zero debt up to about a $40 billion gap, and we're heading back to being balanced, except the COVID came along, and it's now starting to blow out again.
Absolutely. So we can, thank you. We can see that by this chart here, which is the federal government deficit or surplus, and you're spot on. In 2006, we were in a slight budget surplus, and since then, we've basically been running deficits. And you're absolutely correct. The Morrison government kind of campaigned heavily that they were going to go back into the black and start running surpluses again, and they did indeed get very close, as we can see in this chart.
I'd like to suggest that they got to surplus, but in actual fact, if October last year they started to run a deficit again, and in hindsight, maybe the COVID was a good excuse for not meeting their surplus target.
But it is, the deficit is expected to blow out a fair degree. It's probably it is going to be the largest deficit we've ever seen here in Australia. They're expected to run a total of $213 billion in shortfall in this financial year. And look, I think that is worth noting that even though they are borrowing to spend that amount, that's $213 billion that they're pumping into the economy.
And the problem we need to look at in the future, and just a little bit early to talk about now, but if the 200 billion deficit, if they take that away too quickly, it can have some implications for our economy, 2 or 3 years down the track. But hopefully the government will maintain their deficit spending. Otherwise, the fiscal shock will be too big for our economy. Thanks.
Yep, absolutely. No, thank you. All right. So, you can't just run, well, maybe you can just run huge deficits forever. And we can see that the total amount of debt that the federal government has accrued, is increasing quite rapidly. Um, so, net debt is expected to reach $703 billion this financial year, and it's expected to reach almost $1 trillion by FY 23-24.
They
Um,
talk about net debt here. There's a gross debt which is already up around 900 billion, which is going to increase to about 1.7 trillion. But because the government invests in mortgage-backed securities, etc., they do like talking about net debt. So even though there's going to be 1.7 trillion of government bonds on issue, the debt on a net basis will end up at about 1 trillion.
Absolutely. And as a proportion of our GDP, that's expected to get to almost 50%, in the next few years.
And by all
So
measures, 50% is quite a good number compared to Japan, which is on the slide here.
absolutely. So, our federal government debt as a proportion of GDP is expected to reach close to 50%. If you compare that to, these are the G7 nations here, the lowest amount of debt there is Germany at 65%. And you quite rightly point out, Japan's federal government debt is 250% of GDP. So even though we're starting to accrue large deficits on a large developed economy comparison, we're really not that high at all.
Japan started running these deficits back in 1990 when their property market peaked, and their interest went back to zero back in 1990. So for anybody who's bearish by the fact that governments borrow too much money, there's a lot of doomsdayers out there. Japan's been doing it for 30 years, and they're travelling along quite nicely, predominantly because they internalise that debt. There's not a lot of Japan does not owe debt to overseas countries. So we're at 50%, going to 100%, but that's still containable on an international basis for people who are overly concerned about that.
Absolutely. Absolutely. So there's been plenty of new measures announced. Obviously, when you run a $213 billion deficit, you're trying to support the economy, and you're doing a lot of increased spending. This is the jobs and growth government, and so obviously the growth is generally expected to come when you spend, but the jobs they've also focused on as well. So there's been some. Yeah, sorry.
Oh, sorry. You've talked to somebody at the training apprenticeship training. What did they say, Sam?
Yeah, so I've basically been trying to figure out, how effective the wage subsidies for new apprentices are going to be. And I spoke with the head of a training organization for new apprentices, and he said, well, before the announcement, you couldn't place an apprentice, and these days they've got, well, he works for electricians. They've just got electricians ringing up to see how many they can get, because it effectively amounts to about a 50% subsidization of new apprentices, and with a bunch of the budget funding towards construction, there's a lot of interested parties in hiring half-price apprentices, basically.
We had Phil Lowe, the Reserve Bank governor, talking today, saying that because a lot of young people lost a lot of jobs in the COVID virus scenario. He said there wasn't much point in lowering interest rates because it'd be useless. So the great thing about the budget is that they've really targeted jobs for young people, and the training programs, the wage subsidies for apprentices. For 18 to 29-year-olds get $200 a week. So I think the budget's been very good for jobs, and so that's a fiscal measure as opposed to a monetary stimulus that the RBA could have done but didn't, because they figured it would have been fairly useless.
Yep, absolutely. So you quite rightly point out, most of these employment measures seem to be targeted towards younger people, and given that they've borne the brunt of the economic consequences of COVID, that's, I think, a good thing to see. There is also A lot of spending in the infrastructure, defense, and healthcare spaces that are designed to support employment as well. We'll touch on those shortly.
The
The
federal
other,
government spends about 1.5 to 2% of the annual budget every year, or of 2% of gross domestic product. So defence is a fairly high priority for the government, and they target like the submarines. They try and get the spending back into the local economy, which is quite good.
absolutely, absolutely. The other, I guess, big feature of the budget was the tax changes. So personal income tax relief is coming to a large amount of Australians. 7 million to receive $2,000 or more in tax relief this year. And that's predominantly some of the planned tax cuts that they've brought forward. There's also a lot of tax changes for small and medium businesses. There's the carrying back of tax losses to prior years where you have profited. And then there's also the instant asset tax write-off as well for some investments.
Yeah, Rob. So what the government's done is that there's that 19% tax bracket above 30,000 up to about $32,000, I think. So they've lifted that 19% tax bracket up into the low $40,000. So those tax relief measures are very targeted towards the low income earners, and obviously the higher income earners have been left out of this budget. So it's going to get backdated to the 1st of July. So people should be making sure their employer are applying as soon as the measures are introduced through Parliament. Got to go and talk to your employer and ask them to apply the new tax tables backdated to the 1st of July. So people get benefits of the immediate tax decrease. The tax losses. So if you lose money this financial year, but you paid tax last year, the government is prepared to give you a tax refund from taxes paid the previous year, which I think is fantastic for small business. Personally, I'm not a big fan of the instant asset tax write-off. Small business, it's hard for me to in a service economy. We've got a lot of digital technology. We're not building plant equipment. The best thing you can do is buy a $50,000 car, but that's helping an overseas manufacturer. The thing is, if you get a $50,000 deduction this year, you would have got that deduction over 10 years anyway. So you're not getting a 30% deduction on 50,000, which is a 15,000 benefit. You're getting the 15,000 this year, but you would have got the 15,000 over 10 years. So the real benefit is, how much interest you save on borrowing that extra $15,000. So not a big fan of the instant asset tax write-off, other than I'm sure a lot of businesses will use it to buy their new car.
Mm-hmm.
Thanks, sir.
Absolutely. Yep. And, some of the employees might get new cars as well with some of the fringe benefits tax changes. But again, it's I think far more marginal than the changes brought about with the income tax. All right, so there's been lots of new spending committed towards infrastructure and R&D, billions for new infrastructure projects, as well as billions more for accelerating existing infrastructure projects. So there's some that are underway that they're hoping to complete quicker and on a faster timeline by pumping more money in. We're also seeing upgrades to Australia's water infrastructure. And part of this is trying to reduce the amount of evaporation that some of our water systems experience. We're seeing road safety upgrades. I guess now is probably a good time to do it with less people on the roads. You're going to see the M1 or equivalent roads closed down. You may as well do it when there's less people driving around.
These are quite good measures, given there's going to be a downturn in the construction industry. The net immigrations is going to fall from a few 100,000 people down to probably net negative. So there's construction's already falling off. Building will be falling off. So you would expect that any infrastructure bring forward some spending on infrastructure will create those jobs that are probably going to be lost to the downturn in the construction sector.
Absolutely. There's also new research and development initiatives and grants, funding for businesses that want to conduct their R&D. And they're also spending a fair bit extra money on low emissions technologies and renewable energy.
The current government won't commit to the carbon neutral target of by 2050. They'll say that that'll probably cost jobs, but at least with what you're seeing, the government they are spending money on low emissions and renewables, and I think that'll be welcome in the economy.
Yep, absolutely, absolutely. And I think in the notes to the budget statement, they did sort of talk quite bleakly about the future for coal. At least the expectations for volumes and prices for coal were down a fair bit. So I think they do maybe not explicitly but implicitly sort of recognize that the writing is on the wall for some of the sort of
it was interesting. The last couple of days, China has committed to carbon neutrality by 2060, and albeit a fair way off, it would suggest that our dirty coal industry might not have a long-term future. It's something we definitely got a plan for.
Absolutely. Well, funny you should mention China, because the budget did have large investments into cybersecurity. So they committed several, I think it was just over $1 billion towards improving the cybersecurity of Australian government agencies. And that's actually something we've looked at quite a bit on Emerald. There are a few sort of ASX listed cybersecurity stocks that sort of seem quite attractive to us. One of them is one of our Emerald recommendations, and we think that it's wars in the 20th century and beforehand were fought on land, and there was an awful lot of defense spending. Wars in the 21st century and onwards are increasingly being fought online, and you only have to imagine how much funding and materials are going to go into that, and we think cybersecurity could benefit immensely from that.
And it's interesting watching the US-China argument about Huawei not wanting to use their 5G infrastructure, albeit that Huawei is probably the world leader in that technology. And the noise about trying to get TikTok divested and sold into US companies. So there's a very major concern in the US, especially about China's influence and China's access to data. I'm not too sure the current European stance on that, but cybersecurity and the advent probably of the Bitcoin world coming to a store near you over the next few years, cybersecurity will be at the forefront of any development plans.
Absolutely. I think, as you mentioned, cryptocurrency in the past, it's been a major concern of crypto investors, just the security of having a purely digital asset. And we've talked quite a large amount amongst ourselves. That confidence hasn't been there for investors in the past. So another industry that'll grow with the cybersecurity as well.
And personally, there's a lot more talk about Bitcoin and blockchain. I think it's going to be a massive growth opportunity, but the safety of that will need to be sold to the everyday person before I think it gets legs.
Absolutely. Well, in other spending, there was other defense spending for physical defense assets. They've brought forward a lot of investment into, I believe, things like shipbuilding, and other defense hardware for conventional warfare. And there was also increased funding for healthcare services. So they increased the funding to the NDIS, the National Disability Insurance Scheme. There's increased funding for aged home care. And there was also increased funding for mental health services, which historically has perhaps been an area of healthcare that's been a bit underfunded by Australian governments.
And the healthcare point is about your investments as well. one of the sectors obviously doing very well over the past several years has been the healthcare sector. We've got the baby boom generation now retiring. Healthcare is at the forefront. Plenty of demand for spending, and there are plenty of investment opportunities to take advantage of the bullishness in the healthcare sector.
Absolutely. I think if you look at our stock market, there's not a whole lot of export success stories left, unfortunately. There's the miners, and outside of that, there's healthcare. So, in terms of Australia competing on an international scale, healthcare is one of the areas where our companies can certainly do that. All right. So all of this spending, you're expecting to create some change to the economy. It's the jobs and growth government. And this is what they're expecting their spending to do for jobs and growth. So on the left, we have quarterly GDP. They think that after their additional economic support, we're going to see a smaller contraction in GDP and a quicker recovery. And they're also expecting unemployment will peak a lot lower and recover a lot quicker again.
My view on that, going through the budget papers, I think the budget papers are always rosy on the GDP growth forecasts. I mean, they're talking 1.5% decline, followed by a 4.75% increase, followed by a 2.5% increase. I think the chance of getting in a couple of years 4.5% GDP increase is just fairyland stuff. If you go back 10 years, when you see those charts comparing actuals against forecasts, the government will get it wrong again, but they need to put a big number in there to make the budget forecast look a bit more rosy. Not a negative thing. It's just a bit too optimistic, and I don't think it would change the path of how what you would do in investing because of that. But the chances of that line being as steep as it is, I think, is fairly small.
Absolutely. The other thing is employment, and we did actually see Australia's unemployment numbers for September, I believe it was today, and they're actually a lot better than expected. So unemployment came in at 6.9%. They were expecting 7% unemployment. The participation rate was fairly flat. There were jobs lost, but it was less jobs lost than expected. I think about 20,000 full-time jobs lost.
If you're breaking down who is losing their jobs, the jobs that were lost are in the less secure jobs, the hospitality industry. So as the pubs, clubs, and restaurants were closing, those people were easily laid off. But equally so, when the pubs, clubs, and restaurants reopen, those people will be very quickly to get their jobs back. And I think the unemployment rate, given that we reopen, I think that's fairly realistic.
Absolutely. So I think one of the themes about the modern labor market is really, really high mobility. So you're seeing people lose jobs very quickly. You're seeing people regain jobs very quickly. So, I think that is worth mentioning is in the past when you did have a large economic shock, you'd see people out of work for an extended period of time. Whereas in, a modern, labor market that's sort of advanced and developed and very mobile like ours is, you can see unemployment fluctuate an awful lot, and people, can often find work after a fairly short period of time. So I do think, it's a testament to, I guess, the fiscal stimulus, but also the mobility of the modern labor market. All right. So since they made the budget announcement, our stock market has been going gangbusters. You can see that it was made on the night of the 6th of October, so just after that short green bar there. And since then, it rallied extremely strongly. So the market absolutely loved the budget. And, why wouldn't they? The government's going to borrow to spend $213 billion, and they're going to pump that money into the economy. Who's going to be the beneficiaries of that? Well, everyone should be the beneficiaries of that, but, the Australian economy is largely made up of Australian companies, and plenty of them are listed on our exchange. So, big positive response to the budget. I think they were very impressed with, the headline deficit number, because they realize that, some of that spending will flow to them.
And again, the market took a nice little jump today, albeit it was negative overnight, on Phil Lowe news that he was prepared to drop interest rates. We can talk about that a little bit more later, but on the prospect of lower interest rates, we noticed the 10-year bonds in the Australian market dropped down to 0.74 of 1%, matching the US interest rates, and that's down from about 20.94 down to 0.74. So in short term, quite bullish, but we'll talk about that a little bit more as to what Phil's low opinion of dropping interest rates too much is. Thanks.
Absolutely. So just because, the market's rallied strongly, I don't think that means that everything is going to rally. We've seen in the US, there's been lots of spending. We've seen in Europe, Japan, when there's lots of spending, doesn't mean that everything rises in unison. Certain sectors, certain companies benefit, and some companies don't benefit at all. And some of the interesting notes from the budget statements, I think, include, a big drop in expected migration numbers. So they're expecting net migration to fall to negative 72,000 in this financial year, which is a huge fall given, we've recently run very large net migration surpluses. And, in large part, our economy has grown recently on those large net migration numbers. You look at the education sector, the housing sector, big beneficiaries of migration-based population growth.
Having a prime minister with a background in the property market, the successive governments, but especially the Morrison government, love big migration. Bringing in 1 million people over 3-4 years. The government turns around and says, "Oh, look at us, we've created 1 million jobs." Well, you did bring 1 million people into the country, so that's where jobs were created, by people coming into the country, and the migration were a big part of the boom in property prices, as people fought to live in the cities and in the inner suburbs, and we're all aware of that. We have not lived in an environment where immigration, as presented here, is looking to be negative. The plenty of anecdotal evidence reports in the paper. Rental yields in the Melbourne city have dropped off substantially. So the Asian education market's not coming in there to fill up the units. We talked about the construction downturn. So to counteract that, the government will be, still focusing on the first home buyer grants, letting the banks drop their loan serviceability criteria. They're not going to ask as many questions. These safe, responsible lending laws were canned. So the government is going to put an emphasis on making it easier to buy property, lower interest rates, lower barriers, higher first home buyer grants. It'll throw a whole suite of things to bolster the property market. So expecting a large fall, it's probably not going to. Personally, I don't think it's going to happen, but I think with these low interest rates and enough stimulus in the economy, Sydney, who's got the real estate market fully open, is seeing some good buyer demand. Victoria, you can't tell because we closed, but West Australia is actually almost pre-COVID level. So, thanks for that.
Yep. No, thank you. The other thing I think is worth mentioning about the notes is that they actually lifted their forecast for the iron ore price, which recently have been quite negative. It was still negative, but they did forecast higher for longer iron ore prices, and that's going to add, those forecasts will add billions to receipts and billions to the economy in the forecast for the next few years. The other thing that's worth mentioning is coal export volumes and prices were expected to be very subdued. And obviously that's not something that they've sort of brought up or talked about in their speeches, but it does show that they're starting to turn a bit more negative, I think, on the coal space in general. So in terms of who are some winners from, the budget announcements, you can say business, particularly small and medium businesses with, the asset write-offs, the carryback of losses, some of the other tax changes, the R&D grants and things. Some young job seekers will definitely benefit from, the job maker hiring credits. I think, Mike, you alluded to $200 payments for employers per week for hiring someone under 29. There's the job training program, and there's the young apprentices program. The housing. Oh, sorry.
Oh, sorry. These programs won't go off without a hitch because if the big subsidies is for 18 to 29-year-olds, watch some gaming of the system as people are concerned that the older employees may get laid off so the employers can hire younger people. Watch for the gaming of the system. There may be some inequality there, but good intentions, but like the pink bats scheme of 10 years ago, let's see the unintended consequences of that.
Mm-hmm. Absolutely. Now, I've listed the housing and construction industry as a winner. Now, obviously, we know the outlook isn't great. The lower migration, the I guess people working from home, that's going to decrease demand for some real estate assets. But I do think that, if not for this budget, things would be a lot worse for that industry. They've benefited a lot from a lot of the incentives announced. A lot of the funding is towards that sector of the economy. And as a result, I think they're a winner from the budget while being a loser from the overall economic situation. So yes, there have been an increase to the first home buyer scheme. They're increasing it to additional applicants, as long as those additional applicants go for new properties. So they're trying to encourage construction there. And then also the increased infrastructure investment should help that sector as well. Healthcare, again, is a very big winner from the budget. There's vaccine funding for the NDIS, mental health services funding, aged care funding, R&D funding. There's a lot of funding for the healthcare industry. And, just as I touched on before, they're trying to support the non-mining export success story of the Australian economy. All right. So, who are some of the losers from the budget? Well, I guess the losers are the people who haven't had measures specifically announced for them. The high income earners, I'm not sure you can really call them losers, but some people had been expecting their stage 3 of personal income tax cuts to be brought forward, like the other tax cuts were, and they weren't. So those tax cuts are still coming in 23, 24. So, I guess they've lost out in that regard. Very large businesses with very high turnovers of over $5 billion, are not going to receive the tax write-offs and the carryback of losses. And then some of the job seeker recipients, so the people who'd been benefiting from the increased unemployment payments under the job seeker program, those increased payments aren't going to continue. They're going to end on the 31st of December. And unemployment benefits will move back to normal levels or pre-virus levels. And again, some people have been expecting increased unemployment payments, but that's not going to be the case.
Yeah, we've seen with this government that they have been not wanting to raise, unemployment benefits. They just don't want to do it. They've been very generous in this COVID period. I think next year you'll find the way the government will do its spending. Some areas will do well, some not do very well. Unemployment, people on welfare will bear some brunt of it. It'll go back to their basic ideology of paying as little as possible to encourage people to go back to work. So there may be some political pressure there, and something that the opposition party might be able to get some ammunition on. the businesses with more than 5 billion turnover, Phil Lowe said today in his speech, look, the big companies have done well, and this have really done well. They initially fell. They'd lost about 7.5% of their jobs, but they've really come back fairly strongly to. They've only lost about 5% of the jobs compared to people with companies with much lower turnover. So, the bigger companies, I think, have done fairly well and been able to adapt very well in this COVID period. And similarly, the higher income tax cuts projected, possibly as a government looking to balance its budget, which is this government will want to move back to a balanced budget in 3-4 years' time for fiscal responsibility. Those tax cuts probably won't happen if it's a question of balancing the budget. I can't see them supporting tax cuts for perceived rich when the budget deficit, it would be in a large deficit anyway.
Absolutely. And interestingly, you mentioned that, I think we've had this discussion many times, but some people may argue that, current deficit spending is taxation for future taxpayers. So are they perhaps a big loser when, the federal government runs a $213 billion deficit?
Well, my point is that a lot of people say it, and I just don't think it's true. Go back to 1990 when the Japanese started running their large deficit, and the saying now is your grandchildren will repay today's deficit. Well, in 1990, the grandchildren haven't repaid the Japanese deficit. No payment's been made. No future taxpayer has made any payment as time has progressed into repaying the past deficit. It just hasn't happened. To say that it will happen eventually is like saying interest rates are going to go back to 10%. It ain't ever going to happen. So for a government to go and increase taxations and drive their economy down further into a new recession in the future would be suicidal. So I think we have now seen, with modern monetary theory being very popular, that inverted commas deficits don't matter. Well, they don't matter until somebody thinks, oh, it does matter. But today, and for the past 30 years, or since the 70s, it doesn't matter. So saying that it's going to hobble your grandkids, I just don't think it's an accurate statement.
Yep, no, absolutely, fair enough. Fair enough. So we mentioned that, large deficit spending, low interest rates, huge, monetary and fiscal support for markets does create opportunities, but it doesn't necessarily mean everything's going to rise. There will be, some stocks that'll benefit from the announcement, but there might be some stocks that will receive no support and that may not enjoy many gains from here. In terms of companies that might benefit from some of the infrastructure spending, we have beaten down Lendlease and CIMIC Group, as well as NRW Holdings. There's other construction-related stocks that might benefit from some of the announcements in the short term. Boral, CSR, and James Hardie. We actually saw a report from James Hardie earlier this week, where they updated guidance, and that was very well received by the market. Some manufacturers and suppliers. Austal is a good one to point out here. They build ships, and they've been a big benefit of I believe, a big beneficiary of the brought forward defense spending. And then, some healthcare as well. I pointed out CSL because they've received some of the vaccine funding, but there's plenty of other healthcare providers on our market that'll benefit from a lot of the initiatives announced. And then, good sellers as well. Wesfarmers, JB Hi-Fi, companies that have been able to take a lot of their selling online as well. They're going to benefit from the asset tax write-offs from business. They're going to benefit from the income tax cuts. I imagine there's a lot of people who will be heading towards JB Hi-Fi or to Bunnings or something similar once they've got those tax cuts coming through. So these are just some of the stocks we've been looking at, but there's each stock will have its own story with regards to this spending.
And I absolutely believe this COVID period is resetting the economy and our expectations. And it can sound like a bad story, but I think it's going to open up a lot of good opportunities for business. You're seeing businesses now switch their business model and take advantage. Premier Investments, Solly Lou, says he's selling just as much. His online sales have increased, but he hasn't got fixed costs on selling online, so his margins have gone up. We've seen restaurants in every area, even the upmarket restaurants, where you can pay $200-300 for a meal for two. They have moved to takeaway. My wife is doing online food preparation courses from these very popular restaurants. They've changed their business model, and it's working. The digital delivery of services, the fact that Sammy's in Caulfield at the moment, I'm sitting here in Elwood, trying to presenting a webcast as we normally would do, sitting next to technology is giving us opportunities, and I think that's what we could turn our mind to. There are going to be losers. Personally, wouldn't like to be in commercial real estate at the moment, but there's definitely going to be a lot of winners. And I think if we see it as an opportunity, it'll be a generation not of getting a job for the rest of your life. I think it'll be a generation of entrepreneurship, of people building their own business. And I think the modern digital economy will allow us to do that.
Mm-hmm. Absolutely. So we've listed some of the stocks to avoid, on the market. You've got coal miners. So the federal government is fairly negative, coal prices and volumes. So Whitehaven Coal did have a report today, and they did rise strongly on it, but prices are extremely low compared to even recent history. Migration-related stocks could really suffer from, the virus as well. And they didn't receive too much support in this budget. One of them I think that's worth mentioning is IDP Education under the code IEL. That fell a fair degree today. I think about 6%, 7% at points, because their large shareholders, the universities, were considering selling out of them because they needed the cash. So a migration-related stock there, or international student education migration stock, struggling. Petroleum and energy-related stocks, again, there wasn't really anything for that industry. And two, people aren't really driving. Mike mentioned we're not at work, we're in our homes. I haven't done much driving recently. And while you may see an increase in deliveries and things, that's not making up for general travel that people are doing. And then Mike touched on very quickly real estate related stocks, and particularly commercial real estate. So again, he talked about Solomon Lew and perhaps retail commercial for primary investments, but also office commercial. I think working from home, while it might not be the new norm, large businesses might not need as much space as they did previously. You might see a bit more flexible working arrangements and things like that. Yep.
And just to tell us a stock story, which I read the other day, and it tells a story, Disney in America. It's an interesting story. So the traffic into picture theaters of the past 10 years have fallen 20% pre-COVID. Obviously, theaters are now deserted, and a lot of chain theaters in the US are going bankrupt, not reopening. And then companies like Disney, who've got their big slate of superhero movies, aren't doing too well. How do they distribute? And I was reading a good analysis where, like Amazon, Disney should move to a subscription service for new movies. So they've got their Disney Plus at the moment for streaming. But if they said, listen, you've got to become a Disney member, like an Amazon Prime, you've got to become a Disney member to come to our theme parks in the future. If you're a member, we will give you a new release superhero Marvel movie a week before it goes to theaters. Disney is a very powerful company that's got a massive intellectual property in films, and they're vertical integrated. And like Amazon, I bought my new Android Samsung watch on Amazon Prime the other day, and they said it'll get to you in a week, and it'll cost you $6 for delivery. But if you become a member of Amazon Prime, free delivery, and you can get a subscription to Amazon Prime to watch a few shows. So this vertically integrated delivery from Amazon, Disney could do it. Since reading that article, Disney's gone from $120.50 to up to about $126, $127. So stocks to avoid, theatres, stocks to look at, companies like Disney who can deliver new theatrical movies to your screen for your family for $29.99. They're the stories we should be trying to follow.
Absolutely. And I think, you're going to see technology replace a lot of, physical businesses. I think we've seen it with pretty much every industry. You can talk about fintech and bricks and mortar stores. You don't really see many sort of bricks and mortar tax agents and things like that anymore. It's all done online. And, I think entertainment is one where traditionally they do consume large amounts of real estate and have high, leasing costs and things like that, being displaced, very easily by technological offerings. We do have a question from Paul, who's asked about travel stocks, Qantas, Sydney, etc., and insurance stocks, QBE, IAG, etc. That's a good question, Paul. I think some of the travel stocks have been beaten down so heavily that any sort of news about reopenings, any sort of positive announcements such as the Australian-New Zealand travel bubble recently, that can cause buying. And we do think, from a short-term perspective, those reopening announcements are really positive. In the longer term, though, I think it's going to be on a case-by-case basis. I don't think you can say every travel-related stock rises from here because, definitely lower migration numbers, lower travel volumes for years to come are going to weigh on some stocks a lot more than others. And some stocks are going to be a lot more insulated from that. Insurance stocks, it's also a bit of a mixed bag, I think. With IAG, I think their recent reporting was really quite negative, and I don't think they were too quick with their plans about how they were going to turn things around. They didn't have plans for improving their situation other than we're just going to hope the economic situation improves. They had a lot of executive changes, whereas QBE, they have a turnaround plan ongoing. And if I was looking for an insurance stock, which I'm not, it'd probably be QBE I'd look for over IAG. Let me put it that way.
I was just going to say Sydney Airport. People say, "Oh, well, terrible stock because travel is 80% down." But reading some analysis on it, Sydney Airport is probably priced for 4 to 5 years of downturn. Sydney is it a monopoly asset or near monopoly asset, like Melbourne Airport? I know there's the second runway, but Sydney is a monopoly asset. If the price of the share price today prices in the downturn of the next few years, then they are investment candidates. So when you're looking at any stock and you're going, "Oh, look, it looks terrible. Why would you buy it?" Well, you need to strip out the losses for the next couple of years, because well-run companies like Flight Centre, they can come back if they got the infrastructure and the good management, and if the share price is priced a 2-year downturn, why wouldn't you buy it? So it's how you can analyze that stock and strip out the next 2 years of bad news are some opportunities.
Absolutely. All right. So we did see the RBA, RBA Governor Philip Lowe speak today. He spoke to the Citigroup Annual Investment Conference. So I'll just quickly let you talk about that, Mike. But before I do, I'll just let you know we did get a question from a Jess in the audience. If future taxpayers will not be paying for the deficit, who will be paying? So thanks very much for that question, Jess.
take the Japanese example. They started borrowing in 1990, and today they've gone from 250% GDP deficit. Our equivalent would be, our annual deficit is $2 trillion thereabouts. So our equivalent would be $5 trillion of debt, and we currently stand at 900 billion. The point is, what we need to understand about governments that can print money, they just can keep the printed money out there. That 5 trillion Japan's got has not been repaid, unlikely to be repaid, and there is no requirement from anybody to repay it. The thing about the modern monetary system is that it's currency, debt and governments are not tied to a gold standard. They're not tied to America, Japan. All the modern economies have what they call fiat currencies, and they can print, and they don't even need ink nowadays. They just need some electricity, and there's plenty of that. So anybody who says that there's a date that debt has to be repaid, it's just not how the monetary system works. You just don't have to do it. Now, it may be repaid if you're running trade surpluses and you can tax your people at 30% and raise it to 40%. But I think in any scenario that would just throw any country into depression. So the way the modern reserve banks, Federal Reserve, are trying to talk about their debt is as a percentage of GDP. So the mandarins will say to you, look, if my debt is 100% of GDP and it's growing and it's not growing, if my economy is growing at 3.5%, by definition, that ratio is falling because my economy is growing. Therefore, if my debt stays the same level, my percentage of GDP will be falling with a growing economy. And that's what they all say. And that's why the RBA, or the budget, the 2020 budget and every other budget, always, I've been reading them for 20 years, always forecast 3%, 4%, 6% GDP growth as a way to justify the level of debt. So to answer the question, it just doesn't have to be repaid. The governments are not households who have to repay. They just can print more. Was that too long-winded, Sam?
No, I think that's a good way of explaining it. I'd probably say something along the lines of they're hoping that future growth makes up for the increased deficit, essentially. So if the government ran, had $1 billion deficit in 1950, well, these days we'd say, what's $1 billion? But back then that may have seemed like a lot of money. They're sort of hoping that economic growth overcomes the growth in the deficit. I think you touched on that.
Yeah. This whole argument falls into, should we trust the US dollar? The answer today is 100% absolutely. US dollar is the world's reserve currency, and they have got the privilege of being the world's reserve currency, albeit we'll all possibly agree they're abusing their position. They're only allowed to borrow the much as they do because they are the world reserve currency. But the ancillary to all that, you will notice that Bitcoin prices are increasing up. Ethereum, the second most popular coin, is increasing. There's plenty of talk about the US Federal Reserve is actively investigating a blockchain currency. China, I think, is already in trial of a coin, and several other countries are as well. So you'll see a lot of movement in this space because people are losing confidence in that fiat currency, and that's probably where the solution possibly will lie. If the Americans want to bully the Chinese too much, and the Chinese will, stop accumulating US reserves. So it's an interesting area, and we could talk for hours.
Absolutely.
Yeah.
But
We better not.
we better not, because it's its own webcast. It's its own series of webcasts, perhaps. Um,
Yeah.
I'll
Let
quickly
me.
let you. Yep.
Yeah. I'll just quickly summarise Phil Lowe's speech. Look, he just acknowledged that the bigger companies and older people did quite well out of COVID. They kept their jobs. The bigger companies found it easier to switch their businesses around. Smaller businesses obviously did very badly. His comment was, look, when it all started to happen in March, they left interest rates alone. He said there was nothing we could do. If dropping interest rates in March, April was useless. He admits to it. It was, for the first time, it was up to the federal government to step up and do something, because quite often, and we got to. I just want to say we got to acknowledge what's happened in the last quite a few years, is that the federal government was trying to balance its budget, which is a contractionary fiscal policy. That means it's contracting, trying to go to balance, and all the pressure was put on the RBA to drop interest rates, and they did, to 0.25%. So Phil Lowe was happy to acknowledge that the federal government, to put it nicely, pulled their finger out and just really did a good job with spending a bucket load of money. And Phil Lowe says that's exactly what needed to happen. The issue that Phil Lowe acknowledges, look, cheap money makes it easier to cheaper borrowing. It does help the system, but he does believe that if money gets too cheap, it will encourage businesses that should not be in business to stay in business. It's sort of an implicit in his last couple of paragraphs. There's a downside for interest rates being too low. Zero interest rates pretty much justifies any investment, and they're monitoring that. So if the Australian RBA is unlikely to go into negative interest rates. And his final comment was they consider Australia in the context of the world. He recognises Australia is a small middling player in a big world economy, and we need to maintain competitiveness, especially on interest rates. We're a net world borrower, which appears in the balance of payments. We're a net world borrower. We need to hopefully have a trade surplus to feed into our balance of payments. But he acknowledges that if our interest rates get too low, why would you invest in Australia? The equation's different for America, which is the world reserve currency. There's different reasons to invest in America, and China, well, they're just in surplus, so it's not an issue for them. So Australia, he said, Australia's got to recognise who it is in the world and how we need to maintain our competitiveness on our currency, which says that, look, the RBA is probably prepared to get very, very close to 1, unlikely to go to 0. And if anybody was planning for negative 0.5% like Germany, I just don't think it's going to happen. And if I could have just 30 seconds, Sam, on just talking about the election scenarios in the US. From my reading, the consensus best case scenario for the investment markets. So we've got to take a positive aspect on what we're trying to do, make money on investing. The most bullish would be a Biden president with a Democratic Senate. The left wing Democrats are prepared to spend more money on stimulus. The difference between the Democrats and the Republicans is that Democrats are prepared to spend it on the average person. The Republicans are more inclined to spend it on the mega rich, a la their capital gains tax relief, and their dropping the company tax rate. The Republicans are more in favour of the big guy. The Democrats are prepared to send out checks to everybody. So the most bullish scenario is Biden and the Democrats also controlling the Senate. If Biden wins the presidency, but the Republicans control the Senate, they're going to block everything. and that's probably a fairly bearish scenario. You should be looking for much lower returns. Biden, Republican Senate, much lower returns and higher volatility. Probably safe to shift into cash, high quality bonds. Might want to leave the risk assets alone. Trump and a Republican Senate, we're just going to get more of the same. Unfortunately, Trump seems to favour the bigger companies, a la the FANGs, Facebook, Amazon, Netflix, Google. The big companies will do much better in a Republican presidency with a Republican Senate, and the little guys is just probably going to get a little bit more hurt. So I think, and I think it's almost, for my reading, I don't know how everybody else is saying it, the best case scenario is a Biden and Democrat Senate, and we hope to cross we don't get a hung election where we don't know for a couple of months. If Biden wins and there's for whatever reasons, a sell-off, I'll be looking to buy the dip. Thanks, Sam.
Thank you. And thanks very much for that. There are a few more questions. I will touch on your question, Neil, very shortly. I'll just very quickly touch on Paul Benedict's question, Paul's question. Who will win? My personal belief is that we will see Joe Biden win the presidential election, and I don't have an answer for you in the Senate positions, but I will say it's only, I think, is it a half election for the Senate positions? It's only a partial election for the Senate positions, which does make it a bit more difficult given the current composition. But at the same time, they're less partisan with their voting in the U.S. parliaments. So my belief is that Joe Biden will in fact win the presidential election, and I did pick Trump in 2016 to win as well. So
you would say that now.
I actually did bet on that proposition and made a large amount of money on it.
Just joking.
So look, thanks for joining us for this session so far, guys. We will open the floor to some more questions, and Neil, I have seen your question. I will touch on it very shortly. If you just very quickly allow me to explain some of the things that we do here at Emerald Equities. So we provide extensive fundamental research to our clients. We provide earnings seasons updates for Australian stocks as they report, and for stocks in the US, because they're probably the most important equity market on earth. We've got all the stock news. We provide stock recommendations as well. Emerald Equities has charting. It has our unique quantitative rankings. So we've created scoring systems that we believe are very, very attractive for ranking Australian listed stocks. And we provide you just about everything else you'd need to be a successful ASX investor. So if you do want to hear a bit more about that, you can go to emeraldequities.com and you can sign up to a membership there. Or if you just want to have a chat with us about it, you can type yes in chat, and we'll get in touch and we'll let you know a bit more about it. All right, so yeah, look, thanks again, guys, for joining us for this. I'm going to open the floor to some more questions now. As I mentioned, if you'd like to hear a bit more about the services we do provide execution services as well. You can just type yes in chat. Otherwise, type out any more questions you may have. And I'll just start with Neil's question, because I'm sure he's been waiting patiently for us to answer. Super funds, etc., buy bonds, and there may be an opportunity cost through reduced returns to investors in bonds relative to equities. So I think that's a very good question, and I think it's worth making a bit of a distinction between, I guess, corporate and other bonds, and then government, especially federal government bonds. So yields on federal government bonds are pretty low in the developed world. You can get some higher yields in some more emerging government bonds, but yields on those bonds that people want to hold are very, very low, and prices are very, very high. So the reason that most investors are buying government bonds isn't necessarily the high yield or the huge returns, but it's often as an insurer investment. They realize that perhaps might not get as much, but they think the safety of their money in that investment is a bit higher. So Sorry.
Go on.
I was just going to say, so generally, you probably would expect, shares and more riskier assets to outperform government bonds, just because they have a higher level of perceived risk.
My comment from a portfolio construction point of view, the old, forever tactics of 60% equities, 40% bond. I don't think that is there anymore. Take your 10-year bond, okay, it's 0.74%. What's the lowest the Australian 10-year bond can go? Well, I would say, get to 0.25%. But when bonds were 5% and there was an equity correction, the downward force on the bond yield would compensate you for your loss on your equities, and that's why it was called the balanced portfolio. But if you read any modern sort of take on a balanced portfolio, what protection is bonds giving you? The government bonds will give you a return of capital as opposed to a return on capital. You'll get your money back. But the bonds will not give you the capital offset of a falling share market, and people are coming to grips with that, and that is why the market has moved into these much more risky assets. I'll call it consensus at the moment. The reason there will be where another bear market will start is in the credit market. A lot of US companies bought their shares back over the last dozen years. As we all know, the airlines bought their shares back, and now they want to bail out. That's another point. But they bought their shares back, and they issued what they call BBB bonds, which is just barely investment grade. If any of those, if there's without the government assistance in buying bonds, those would have fallen to non-investment grade, and a lot of that would have been sold off. So the next downturn will be a credit event, and I noticed there's a lot of the corporate bond funds, it's sort of promising about 5% returns, running yield 5% returns. But the next crisis, those barely investment grades, the BBBs, will probably move to BB, CCC. It will be a credit event. So, and it won't be as much as an equity event. I mean, even at buying Microsoft as 50 PE, that's still a 2% return. The big cap stocks will be looked at as almost bond substitutes if they're in a safe enough moat of investment. So I just make a comment that bonds will just not give you the protection you got years ago. It will definitely give you your capital back. And in Germany at the moment, the 10-year bond rate's negative 0.5%. The reason some funds buy it at 0.5% is, well, they get some of them get a chance to sell it at the lower yield of minus 0.1, but nobody really wants to hold an investment and to get less capital back. So I just wanted to make that point about bonds.
Absolutely. We've got a couple of questions here. One from D. What's your view about electricity stocks? And again, I think it's not necessarily a sector that we think that highly of, for one. And two, it's perhaps a bit of a sector where, you could have some outperform others. So it's probably something I'd in general avoid at the moment, unless you have a very strong view about the future of a particular one. I think one to point out quite strongly is AGL. They reported really poorly in August. They said that next year's results are going to be really poor as well, and they basically gave no indication that they were going to try and improve things too much from there. No indication of big investments, no indication of turnaround plans or anything like that. So look, I think with the electricity generating and retailing, it's something that I think we're in large part avoiding at the moment. Also, what do you think of? Sorry, another question from D. What do you think of some of the software companies that have gone so high? So another very good question. I'm assuming you're meaning the tech stocks as well. A lot of IT sector stocks on our market have run extremely strongly from really low levels. Some of them to multi-billion-dollar capitalizations on very little. And I'd just be a bit cautious because not every one of those tech stocks will be around in 10 years time. So there's stocks that have exploded, and I don't think they're all going to be around in 10 years time. There might be some that are still around, and there might be some that are trading at even higher valuations that have rallied and risen extremely strongly. But I think that a lot of the valuations in the Australian IT sector have become a bit stretched.
My comment would be there's very large volatility in those stocks that are trading at multiples of revenue as opposed to multiples of earnings, i.e. they're not earning much. It brings me back to the dot-com bubble in the year 2000. Very similar price actions of companies that you probably vaguely remember, but wouldn't care to remember after they've crashed and burned. Look, it's also tempting to watch a stock like Afterpay go from $4 to $80, and so I wish you had a piece of that. But from $80, where does it go? It's a capital hungry business. Downturn in the economy, it will suffer. You say these sort of things, and then the price doubles, and you go, "Well, did I miss out?" Well, it's a question of how much risk do you want. It's amount of how do you balance your portfolio out. Will you put 20% of your portfolio in there? No. Will you put a couple of percent? Yeah, look, maybe. Keep your eye on it. Have price targets. Have a good opinion. Yeah, you'll know when it's time to sell because the market will sour on that credit event I was just talking about. At the end of the day, buy now, pay later is about credit. It's about lending to people who otherwise would have borrowed 20% on a credit card. It's a new market and it's exciting, but as it matures, I think people will be a lot more cautious with it.
Absolutely. Just a few more final questions. Deepu, you've joined a bit late. I'll make sure we send a recording out to you tomorrow once it's past our compliance team. Rob, with a focus on clean energy going forward, what are the chances uranium prices and stocks will increase soon? I've been hearing about a forecast increase in uranium prices and uranium stocks for a decade now, and it always seems to be just around the corner. I've heard very positive things about some of the uranium stocks on our market, but it's not a sector that I've touched because it seems to, every time I hear about it, it seems to be just 12 months away, just 12 months away. I do think nuclear energy generation is potentially the future, or hopefully it's the future. And specifically, I think if we can generate nuclear fission technology. But yeah, I'm going to wait for more action from that sector until I sort of jump in.
And I'm happy to say that I'm an investor in Paladin at the moment. Uranium, as you know, has had a checkered history. It boomed. I think the stock went from a cent to $10 back in 2000 to 2005, and of course, between the Japanese nuclear explosion, it's gone out of favour. The analysis I read is that, look, if you're prepared to invest in a uranium stock, put it in your long-term portfolio. Do not make it a short-term trade. If you get the move, you get the move, and the day after it'll be too late. So uranium is about worldwide adoption. Obviously, there's nuclear power plants in the US and Europe. People believe its time will come again. as an energy source. A lot of people will politically disagree with that, but some people absolutely believe that uranium stocks will come back. But it's not a short-term play. It's buy it, forget about it.
Absolutely. All right, a couple more questions. Deepu, I think Mike answered your question on the buy now, pay later sector, hopefully. SW, I'll make sure we get a recording out to you. All right, any more questions out there, guys? I've got a question from Patrick. What was our webcast? So I'm just gonna, sorry, what was our website? Apologies. I'm gonna type it into the chat box, guys, so I can broadcast it to all of you. All right, so I've broadcasted in chat there for you, Patrick. Just click that link. It'll take you to our equities platform website, and you can have a look around there. And if you would like to have a chat with us, just type yes in chat as well, and we'll get in touch and explain a bit more of what we offer. All right, guys, I think we've got a final question from Deepu, and then we'll end the session there. I think we have run a bit late, so sorry if we've held you up this evening. But Deepu's asked, rare earth, any insights? Rare earth has, been predominantly, rare earth minerals have been predominantly produced in China for the past many years. It's still 95+% produced in China, and anywhere outside of China that can start producing them even reasonably cost effectively is going to do quite well. However, it is worth noting that it's very environmentally damaging, very expensive, and very energy intensive to separate rare earths. And so it's the projects that have tried often rarely get off the ground. Or if they do get off the ground, they're very, very limited in scope. And you can look at, say, Lynas Corporation, basically, I think separates 1 or 2 rare earth metals. If they can start doing it and they can start doing it profitably, it's a business definitely worth looking into. And I think if you look at Australian Strategic Metals or Minerals, ASM, they've been rallying extremely strongly on the hopes they'll be able to do well in the rare earth space. Lynas Corp as well traditionally trades at a very, very high premium, just because they are a non-Chinese producer of rare earths. So rare earth stocks, I do think, are likely to be extremely positive, but there's a lot of issues in producing rare earth minerals. And the other thing I think is worth mentioning is that just like America and Europe and places want to secure non-Chinese supplies of rare earth, the Chinese do identify other non-Chinese suppliers of rare earth and do try and interrupt that a little bit. And I think we did see that with Lynas in Malaysia, and it can create headaches. And NTU in Western Australia. There are some of the smaller stocks starting to look into to doing some things in the space. So I do think rare earths are worth looking at, but you do have to go on at a case by case basis, because it's a space fraught with roadblocks and difficulties. All right, guys, we've got a couple more that we'll send the recording to for sure. And if you have any more questions, type them out now. I think otherwise we'll wrap up very, very shortly.
And I just wanted to say, sorry about the early sort of missteps. As I mentioned, Sam's in Caulfield. I'm here in Elwood. It's difficult to do these webcasts, not being able to be in the office, and I think we had a little bit of noise coming in from the site. So with apologies, but I think we've got through with our technology reasonably working well.
Fantastic.
Yeah.
All right. Well, yeah, thanks once again to all of you online. It's a great pleasure to be able to deliver this to you guys out there. And I hope you all enjoyed it, and I hope you all gained something valuable out of all of this. Just like to thank my co-host Michael as well. Certainly made it a lot easier, being able to have him here and doing this, in conjunction with him. So yeah, from myself and Michael, thanks once again, guys, and I hope you all have a great evening.
Thank you, Sam, and thanks to everybody for attending. It's been great. Really enjoyed it.
Thanks. Bye.